Hello, ladies and gentlemen. Welcome back to a portfolio review. I just got paid today. I dumped money in, and let's see exactly how we're doing. Portfolio value is $7,220. We have 10 holdings total. The portfolio yield is 7.21%, and here's a list of the portfolio right here. Projected monthly income is flat. I'm basically taking Alaris, which is my only quarterly payer, and splitting it as if it was a monthly payer. I know it's weird, but in the calculation here, I am not counting it. The space is just left blank. Okay, so right off the bat, we have Allied Property. It's a retail REIT heavily in the US. 2004 properties, 99.6% occupancy, 74% payout, 5171 NAV. Now, if we go to them, sorry, I just have to try to find it now. Agree Realty. So overall, we can. I want to try to find the thingy. There we go. Sure, let's get quarterly information. So we're going to just do this. Basically, we're going to go over the release, and then we're going to go over and just overall to see how everything's doing. So Agree Realty, so again, invested approximately $324 million in 120 locations, completed 6 development or partner capital solution projects, total committed capital of over $18 million. Net income per share decreased to 42, but again, it's a REIT. We don't give a crap about that. We care about FFO and AFFO. So the FFO has literally not changed. AFFO has increased 1.1% to 98, which is nice. It's literally even. July dividend of $2.43 per common share. They did just raise it to $2.47. Very small hike, only 1.6, but hey, I'm not complaining. Announced an unstructured $350 million 5.5-year loan at 4.52% fixed rate, which is nice. Settled 3 million shares outstanding forward equity for net proceeds of $205 million. They did issue shares, which sucks. Well positioned, and in the first half of the year, they go over everything. So committed a record of nearly $126 million to 31 development properties. Net shares decrease, core AFFO and FFO. So again, barely any growth here, but it's should be enough to at least cover the dividend that they've set. Declared dividend of 1.449 a share, which is a 4.8% increase from last year. Love to see it. Alrighty, so we're done with that. So moving on to the next one, we have Flagship. I actually really do like Flagship. So Flagship, if you guys don't know, is a manufactured housing REIT. Basically, if you just go to their homepage, this is them pretty much. So it's RV, basically like camping sites, or basically if people live in RVs, there you go, basically a trailer park. Sorry, not that. Sorry, it's just like the RV like areas basically to park, stay for a bit. These are the manufactured housing. So the people legit own the house, and then they own the property underneath it, and they pay the rent. So they basically own the community. Now, you might be thinking, well, that's kind of stupid because you can't really jack up the rent and stuff. Well, you will be very pleasantly surprised when I bring up, I think it's this one. I'm hoping it is. We'll see. So if you go to revenue, so right off the bat, decent growth, 6 months, decent growth. As you guys can see, it's kind of growing a bit. General admin is a little bit more expensive, sadly. Appreciation, distributions, they break all that down at income, comprehensive income. They are issuing shares again, which sucks, but there's nothing you can do about it. Cash flow. This is not the right one, I don't think. No, it's not. Sorry about that, guys. I'm just trying to find... here it is. This is what I wanted to show you guys. So, MHC, so you guys can see, revenue, same community revenue increase, net operating income, same community operating income. Now, same on consistent, you guys can see, they've constantly always grown their rent per lot. So, average monthly rent, lot rent, you guys can see it started December 2017 at $326, all the way till now, it's about $415. Not doing too bad. Occupancy has been kind of all over the place. It's really slowed down, but it's nothing too much to worry about. Break it down. They got awards. They got all this different stuff. I want to show you guys. So FFO, you guys can see there's already been some really good growth there. So, looking at it, a little bit of growth going up. About, I think this is in millions. Yeah, thousands. So sorry, it's about 2 million, like more. They pretty much made AFFO. They've made more than 1 million, and the payout ratio is deliciously 53.6%. Sadly, though, there is a crap ton. They've issued a decent chunk of units. Total communities average rent, so you guys can see this is based on end of last year, it was 388 compared to now. Occupancy, it's like barely gone up. Same community occupancy, it's gone up quite a bit. Debt to gross, so they are tackling some of their debt. Average mortgage interest rates, not horrible. And mortgage years, so it's not horrible either. But either way, like 11 years is your average. There's a good chance that once interest rates, get cut, then it should go up for renewal. Like, let's say it's the worst case scenario, and they constantly, they have to like renew it or keep jacking up interest rate hikes. Flagship's fine. They can easily deal with it. Realty income, this one is a huge amount of debate because the stock price has basically collapsed pretty much. You went all the way from like 70 and you went basically straight down. That's pretty much it. There's really not much to talk about. Oh, because everyone knows everything. Net income was 195 million. Normalized FFO was $1.02. AFFO was $1 exact. Invested $3.1 billion in 710 properties under development or expansion, at an initiated weighted average cash yield of 6.9%, which is nice. Raised 2.2 billion from a common share price. Basically just goes on and on and on and on. Like, they basically just issued shares, issued bonds at the money forward agreement. There's nothing too insane to look at. Like, the payout ratio, like AFFO, it has slightly grown, not very much, but it is enough to cover the dividend. I don't think they actually go into the payout. No, I don't think they actually do. Or maybe they do. I think it's just lower earning guidance, FFO per share, occupancy. Occupancy is over 98, over 98. They should show the payout ratio, right? Wow, they actually don't show the payout ratio. That's really weird. Sorry about that, guys. Yeah, so either way, biggest REIT in the world, it's very hard for them to grow. They have to acquire a huge amount of properties, which is why a ton of people basically ditch them. An argument I had was they're so big they have to acquire 200 plus properties to just barely grow AFFO now, which I agree with. It's going to be harder for them to grow, but they do have a little bit of room. And if they can keep hiking it every single quarter like they have been, or even 4% annually, it's really not that bad. Main Street Capital. I love Main Street, guys. Oh, sorry, that's Allied. Where is Main Street? That's Alaris. There we go. So Main Street is my favorite BDC. There you go. So it's my favorite BDC. It's a business development companies. Basically, if you guys do not know, they give out pretty much loans to other companies, and in return, they get the interest from it. Here is their by industry. As you guys can see, insanely diverse: internet, machining, commercial services, construction, healthcare, diversified customer service, IT, distributors, leisure, tobacco, specialty retail, software, aerospace, defense, electrical, diversified finance, internet, and catalog. It just goes on and on and on and on, and it's all pretty much based in the US, which is really nice. Main, basically financial performance year to date, so they still have a little bit of room left to go. And that honestly is pretty much it. DNII, and they have continuously increased the dividend and also paid a special dividend, which is really nice. This portfolio, by the way. Total return performance since that, so they have literally destroyed the S&P 500, 892% compared to the S&P's 292%. Right after the financial crisis, so this is even with that crazy bull run, Main Street has still just destroyed. It's insane how well they've done. Payout ratio, based on the report they have, they're basically saying it's going to be like like this right here. So our distributed net investment income in the third quarter exceeded the monthly dividends paid to our shareholders by over 45%. 55% payout ratio is basically what they're saying. The total dividend paid to our shareholders by over 5% based upon the continued strength of our performance in the third quarter. We expect another meaningful supplemental dividend to be paid in the fourth quarter. They're telling you right now, special dividend confirmed. This would represent our 9th consecutive quarter supplemental dividend or special dividend to go with the 6th increase of our regular monthly dividend in the same time period. So that also to me screams they're hiking the dividend again another 2%, allowing us to deliver significant value to our shareholders while continuing to maintain a conservative payout policy. If you do not know Main Street's dividend policy, it's really smart. So a BDC, just like a REIT, has to pay out, I believe it's 80% of their income. What Main Street does is, hey, we'll target 60, 50 to like 70%, and in that 10% gap, we'll pay in a special dividend. So if their company takes a massive income hit, they don't have to cut the dividend. They just don't supply you with a special dividend. It's actually kind of genius. I wish REITs did this in the US because I really like it. Because it gets people, really excited because it's like, oh, every quarter I get a special dividend. And, if their income, let's say flatlines, they can still hike it and pay me a special dividend. A-okay. So Main Street is, in my opinion, like the best BDC out there. It's not investing advice, guys. You guys all got to figure it out on your own. But I truly love Main. It's my favorite. Primaris. Primaris is, it says right here, it is Canada's only enclosed shopping center focused REIT with ownership interest primarily in leading enclosed shopping centers located in growing markets. Totals 11.4 million square feet, $3.4 billion of Primaris shares. And it basically goes on and on and on. Now, Primaris is very interesting for a few reasons. Primaris, excuse me, guys, focuses very heavily on buying back shares to basically give you guys your return. So they pay a dividend, obviously. Their goal is to grow it every single year consecutively if they can. They've only grown it once at 2%. They have a 1-year streak so far, so we have quite a bit to go. They have a very low debt to assets. They have a very good rating, a BB high. Excuse me. And it says proper capitalization, very low leverage reduces the REIT's reliance on external capital markets. Basically, they did buy a property, all cash, no share issuance or anything. Leverage is one of the lowest of Canadian peers, etc., etc., etc. This is Patrick Sullivan, President and Chief Operating Officer, Chief Financial Officer. And 29.1% of Canadian residents are within a 30-minute drive of a Primaris mall. And it breaks down their tenant mix, apparel, food, large format, grocery, pharmacy, large format, general merchandise, other, personal health. And you guys break it down. We go right here. Canadian Tire, Walmart, Loblaws, TJX, I don't know what that is. Bell Canada, Cineplex. Yeah, they're doing okay now. Gap, Comark, Dollarama, Rogers. It continues going on. TELUS, Best Buy, Indigo, HBC, MTY Group, American Eagles, YM, Good Life, Foot Locker. I have no idea what this is if I'm being blatantly honest with you. But overall, it is pretty good. They pretty much skipped Saskatchewan, but they've gone like everywhere else, including up north, which no duh. There's not a ton of people up there. It basically breaks down this all. I want to show you guys. Yeah, so this is what they have so far. This is basically their targets. They break it down blatantly for you. That's cool. Where is the... Here we go. So in-place occupancy has slowly gone up, just barely. And committed occupancy, it's gone up. Very nice. They have been able to raise rent per occupied square foot. Total assets has gone up just a tiny bit. And it basically just goes on and on. So the payout ratio for FFO was 51.9, which is just slightly up from the year prior. The AFFO is 77.1 when it used to be 60.3. Now the reason for this, I'm really hoping I can find it. Oh god, I hope I can find it. I'll be really upset if I can't. There was a massive jump in something, and they actually do bring it up and show you. I don't think I'm gonna be able to see it actually. No, it's not. Either way, their tenant allowance is what actually did it. Tenant allowance cost rent. Sorry guys, I'm determined to find this. Yeah, here we go. So as you guys can see, it went up to 8.5, where it used to only be 5.9. So why did it massively jump basically 3 cents a share? Well, the easiest reason, and I only know this because I emailed the CEO, and thank God he answered. It wasn't someone else. Was because basically how it works right now is the tenant holds all the power, so they can make demands, aka, hey, we want to redo our store, we need an allowance for that, hey, we need this, we need an allowance, hey, I want a bigger location, move me, basically stuff like that. So they have to basically help out their tenants. Now, because this basically what he said was, it was pretty much just, hey, it's the season coming, we're going into Q3, Q4, we got to pay this because it will help, makes the tenant happy, they'll stay, we got an Apple store, blah 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 blah. And that's why basically we see such a huge drop, pretty much almost a good chunk of it is just from this. And considering this is almost a one-time thing, if it stayed the same, they actually were flat, so they still have a 60% payout ratio. Not me coping. You guys can make fun of me, you guys can email them and ask them like, hey, why did this number jump like, $2.4 million? Sorry, 2.6 actually, and I'm sure they're more than happy to answer it. But there is that. Now, on top of that too, they've actually started seeing a realized gain by purchasing their shares. They're now saving 3 cents per share from 2020 to 2023. Now they're saving money now. So the joy of this is that the REIT's NAV is like $21. They're well below that right now. They're like 40% plus undervalued based on the NAV. Because they're buying back units, that increases all of our ownership. They pay less dividends. It's a win-win scenario for pretty much everybody. So that is Primaris. Decisive Dividend Corp just announced also they're doing their Q3. I think it's November 7th. I am so excited to hear it. But basically, going over it, they acquired IHT, which is the hog industry. It has amazing margins. We're talking like 40-50%. Sadly, because the acquisition was so close to the Q2 release, it's not included in this. It will be included in the Q3 one. I'm not expecting a div hike now for the rest of the year, but we will see what happens. But they've been growing stuff like crazy. Adjusted EBITDA in the first half of 10.2 million, an 80% increase over the first half of 2022. Generated a record 5.3 adjusted EBITDA in Q2, a 57% increase from last year. Sales increased 32%. Quarterly sales brings sales for the first half of 61.6 million, an increase of 47%. They're crushing it, basically. Now, they did not do well at all, so they generated net profit of 0.9, where before they generated larger profit because they issued a ton of shares to buy IHT and all these other companies. That's not me really complaining. It's me basically just mentioning just a fact. They are going to keep issuing shares, so it kind of concerns me for the net profit. However, free cash flow, they're still doing A-OK. Balance sheet, so they have a conservative ratio of 1.5 times debt to adjusted EBITDA. I'm not too worried about it, if I'm being very honest with you. And they even show you, so free cash flow less maintenance, and then it gives you a trailing payout ratio, which basically round up 60%. Last year was 86%, so clearly they're fine going quite a bit higher. And honestly, that's pretty much it. They break it down here. So the newly acquired businesses, Micon and Procore, contributed overall 26% increase in segment sales. ACR and Capital One Saskatchewan, baby, each contributed meaningfully to the overall 37% increase in the quarter. Love it. I'm so hyped about it. Overall, Decisive is like my one true love. I will keep buying it below $8. I'm just trying to see if I can get it cheaper. I don't know why my prices suddenly stopped loading. So I'm just gonna refresh it really quick. It's like 752 right now. If it gets to 750, I'll slowly start buying it more come Monday. I'm just waiting. I want a better deal, guys. I want to at least get 7 or close to where I'm at. Canadian Net REIT. This is my true love in the real estate sector. I have decided I'm buying the crap out of it. Mostly because right now, if we look at what I'm at a 7.36% yield. They should increase dividends. I'm kind of confident they will. So I'm fine going all the way, let's say, to like, 80, like 480 right now. Which if we go over, still puts me in the 7% range. Like, as long as I'm in that 7% range, I'm fine. So again, I can go all the way up to 492 and I'd be happy. So, come Monday, I'm thinking I'm just going to dump a ton of money into it, and we will hopefully be able to see how we do. Now, going over their stuff, they actually have a really nice breakdown chart. Where's that chart? There it is. Historical selected financial performance. So they literally say this is selective. But they've been around now for over 11 years. So the IPO'd, they made 5 cents, nothing. Then look at this, they started paying like almost everything. And then look at how much it keeps slowly going up. The FFO 23 to 16, 32 to 18, 37 to 20, 41 to 22, 49 to 26, 58 to 30, 64 to 34. It's gotten significantly better. Tenants make up 79%. Loblaws, really good tenant. Walmart, love it. Metro, love it. Sobeys, love it. Suncor, it's gas stations. Tim Hortons, I absolutely love it. Group BSG, I have no idea what that is. Couche-Tard, Parkland, and Bennyco, which I still have no idea what the hell Bennyco is. But overall, distributions as FFO, it has gone down 1%. As AFFO, it has actually gone up 3%. And again, if we just look over here, there was a CapEx they did. So, one, they barely increased units. It's not too horrible. Neo FFO barely increased. AFFO actually decreased. Oh, where is it? I want to show you guys it. I don't think it's in here though. Sorry guys, I want to try to find out the thing just to show you guys what it was. No, it's not. It's going to be in the financials. Oh my god, I forgot. I hate their financials, by the way. It's French on the left and then English on the right. Oh, where is it? Other investment joint ventures, financial deferred. There was... Ken, we're looking here too, by the way. It was a significant jump. I just got to try to find it. I'm so sorry, everybody. Accounts payable. Operating costs. Why can't I find it for some reason? Unit base comp is up significantly. Yikes. Admin cost. What's funny is they are purchasing units. It's just barely any. Damn it, I can't find it. Either way, guys, what it was basically... Damn it, yeah, I can't find it. But they said it in the earning call. Basically, what they're doing is they invested a significant amount of money. It was like, it wasn't that much. It was like 400K, but again, they're a very small REIT. Like, they only made, I think, 2 million, I think, in revenue or something. Like, very, very small. So they used 400K basically to improve a property, which will also generate extra cash flow. So that's why the payout ratio basically jumped up and why I refuse to put 60%. I'm just putting 56, assuming basically nothing changes. Which he said this quarter, Q3, we won't see. Q4, we will definitely see. Alaris. This one is kind of controversial. Biggest reason being, guess what? They had a lawsuit. They won it. The dividend hike is literally all over the place. Like, this one, for example, they went 5 payments without hiking it. Suddenly hiked it. But as it says, it is literally an income trust, so you can't really determine anything crazy like that. You kind of you basically you can't assume they're going to grow the dividend, which they easily could, but you can't really assume that. So going up here, God, where am I looking? Where's the admin? General admin, you guys will see for the year, like border almost tripled, pretty much. It for sure. It's sorry, it's a little bit over doubled, purely due to the lawsuit. It absolutely sucks. They had a huge hit, but they're still trying their best to hit where they can. Going over to the 3 months, they have also, you can see they are starting to struggle now cash flow wise. Easily make enough though to afford that 34 quarterly dividend, so it's nothing too insane out there. Portfolio also is massive. If I bring this up, I hope you guys can actually see this. Yes, you can. So they have financials, utility, metal management, IT, cosmetic surgery, electrical, and then others, like the entire rest of the portfolio. Allied Properties. I love this thing. So Allied is going to announce their third quarter, I believe October. Wednesday, October 25th. And you know what makes me even excited about that? I have the day off, baby. I'm going to literally stay up and just wait for that report. I'm going to be so excited. Now, Allied is still performing absolutely horrible. So if we go to Allied, it's had a really, really rough week. So we're down 2% today. As you guys can see, we got as low as 1570. Go to the 5-day mark. We were at 18. So again, a $3 loss. We still down here, bounced up. So we were still sitting at like a $2 loss a month. Again, we're at 20. Now we're way lower. Etc., etc., etc. So basically, it is really bad. We are hitting an 11% yield, which, don't get me wrong, is awesome. And this is the one thing today, this and Alaris, which I used all my capital in Alaris, doubled down on Allied. And then I sold Tesla too. You guys probably know Tesla is missing here. PIMCO is also missing. Nuked out PIMCO, nuked out Tesla, Alaris as well. Dumped it all into PDI when it got really low. Nuked it, moved it all elsewhere. So that's why some of this stuff's kind of like all over the place. Shoot, actually, yeah, I gotta fix that. 4.69. But yeah, either way, basically that's why I just doubled down aggressively. It ran up, sold it, moved it all elsewhere. Basically the same exact thing I did last time. I forget what I did it with. I think it was with Alaris, and then I sold it for a gain. It came back down. Now I rebought it today. So basically there's that to keep in mind. Now for the Q2, I'm not even going to bother looking at it. So they paid down their line of credit, which I'm hoping I can find. Line of... Sorry, guys, I really want to find this interesting, because this is basically what the entire thing is about. Performing interest. Where the heck is their interest payments? There was a huge one in here. It's not that. It's not that. Or it might be. It might be the unsecured line of credit, actually. Bank proof for food. The feasibility has $100,000 available. The interest. Yeah, honestly, I can't really find it. But I'm pretty sure this is one of the things they're paying, just because it's kind of insane. Like, one of the things they're paying, it was like almost 7% interest, which was just ridiculous. And they were like, we're paying it off like borderline immediately with all of this. So it was, and like again, like looking at all the, yeah, it was this, your unsecured facility. This is what they paid off right here. If you guys were wondering, it was this guy. So come the next earning report. My God, sorry guys, my thing's just lagging like hell right now. So come the next report, that should be massively chopped down. It's neither an amazing thing or kind of like anything really. It's more just they should free up a significant amount of capital. Hopefully they're buying back shares, because looking at this, like we're 2009 levels of price movement right now. I hope they're buying back shares like crazy. Controversial take. Cut the dividend, buy back shares till we get up to $20, which probably won't happen, but like for an entire put it to a shareholder vote and be like, for a year we won't pay anything, and we're just gonna buy shares back aggressively. But the dividend, it's very safe. They can easily afford it as long as the occupancy doesn't drop too much. But as for everything else, they're doing a-okay. My biggest concern is occupancy right now. The dividend, not even thinking about it. It is easily coverable. With their last report, they had an 87% occupancy, 83.9% payout ratio. And, sorry, their sale of their thing dropped it by like 10, so let's say it's 40-80. So we're below 50% still. Discount to NAV. The payout ratio should be fine. I'm not too concerned about it. We have TGIF. I only have 5 shares in this guy. This one is kind of all over the place. Biggest reason being that I made a video on it really quick. Super quickly went over all this stuff here. And as you guys remember, I said, and I was incorrect with this, that I took this, which includes the special dividend. So excluding the dividend and including the dividend hike, the dividend should be around 776. I think this is in thousands. It shouldn't be. I think it's millions. But either way, it is 776,376, and that's the base dividends, no special. That should be around what it is. So 776, 376 divided by, it's like 909. What is it? 909, 482. Payout ratio of 85.36%. And as you guys can see, they've clearly been able to increase their net investment income. This is assuming it's just flat. I'm not including, realized loss, because clearly, as you guys can tell, they sold stuff for a significant loss and then rebought it for this guy here. So overall, 85%, a very big portfolio of bonds from good companies like Ford is not going to go anywhere. AMC, as long as the meme stays alive, they can keep issuing stock and beating people down with it. I'm not too concerned. Goff. I replaced PIMCO with Goff. Spoiler alert. And I did this quite a few days ago, I believe, purely because it got to the point where it was just like PIMCO, severely under NAV. They've done, and then I was like, I'm going to buy it. I'm going to pray to God it actually works out. Because, look what happened. It was stable at 15, 14. Look at this. $16 to $14. It just hovered all year. And then plunged all the way down to 11.16. That was like 20 cents ish off, and then now it's just straight up rebounded. I'm not too worried about the dividend. They are using a pretty aggressive amount of ROC. I haven't really checked the financial report in some time. That's my next video spoiler. It's Guggenheim. I'm going to do that. We're going to see what we can find. The NAV has dropped, as you guys saw in my little notes here. It has dropped 4 cents in a day. Again, I'm not too concerned by it, but everyone is different. Yeah, it hasn't changed at all. But yeah, so it's back at a premium. It was at a discount. Now it's at a premium again. So I'm more than happy just holding it here. It's going to struggle. Like TGIF, PDI, GOF, and even REITs in general. Like, this is just proof that REITs are getting destroyed right now. They're all going to seriously struggle. This portfolio is going to struggle massively. Like, in a day, I'm down almost an entire percent. Market, actually, that's a lie. I'm actually doing better than the market somehow. Okay, I didn't expect that, but whatever. But looking over this stuff, like, this portfolio is going to get destroyed. Like, every time you look at it, I'm going to go, deeper and deeper in the red. The only reason I'm not is because capital gains and dividends right now. But, excluding those things, I'm probably going to go into red pretty drastically with all of these guys combined. So it's just, when you see it, everyone will be like, oh, you're an idiot, stuff, and make fun of you. That's just how YouTube works. I think I'm small enough that the community I've gotten, they kind of believe in it. Like, hey, if the dividend's safe, who gives a crap? Oh, Main Street's fallen? Dude, 55% payout ratio. BDC, pays special dividend, can easily sustain it. Canadian Net REIT, fight me. Decisive dividend, it can sustain. Like, almost all of these stocks can sustain dividend. The only one I'm iffy on is Goff. Only one. And I'm just, and that's only because I haven't really researched it as much as I want to. But, PIMCO is 49% MBS, and that's basically what's been dragging it down. Goff's 3.9%. It's barely that at all. It's mostly bonds, which again, when you buy it and interest rates go up, the bond loses value because, people want to spend less money on it for a lower yield. The NAV's going to get destroyed, basically, is what I'm saying. And they are doing ROC. It's like 53% last time I checked. But I'm not too worried about Goff. But we'll wait and see what happens. Like, if it does cut the dividend, I'm still getting an 8%. I'll be more than happy. If it doesn't, I will be hyped to have it, at 16% here. But yeah, we will have to wait and see. Here's the sector allocation. Again, I am extremely heavy in REITs right now. And if you guys are wondering what is on my buy list, I have quite a few actually. Tesla, I'm kind of iffy on getting back into just because it's fallen so much in such a short time. I kind of want to buy it. I'm iffy on it. Cardinal Energy, I sold out of. I am going to get back in. I had a 12% gain. I'm not losing that right now, so I sold out. BMAX, I actually really like it. CM, I'm iffy on. PAYF, I totally would buy it, but I'm waiting for it to get a little bit cheaper. And then, it goes down. GD, SBC, and GDV, I'm not even considering at this point just because they're so freaking volatile. MPW, I'm not touching. Marwest, if it gets to 59, 58, I'll gladly buy it. EIT, $12. If this thing hits $12, you're going to see a huge shift in my portfolio. I am very likely to nuke GOF for this thing, just a heads up. Purely because EIT, I've waited so long for it to hit $12, which if we go to the year, going all the way down, we haven't hit it at all. Go to 5 years. Look at the, dude, 5 years, you're doing very well right now. We haven't been to $12 since 2021, April 2021. So it's been quite a while, and I really like them. They're basically they hold solid stocks, get paid a dividend, pass it on to you guys, and pay a 20% ROC. It's not very much. So yeah, just massive spoiler there. I totally would do that. Manulife, I would buy here. I just don't have any money right now. Same goes with BMO, especially right now because I think you had a 5.5% yield right now, and BMO is one of the few banks that I think could easily go through pretty much anything. CWB, I'm waiting for it to get a little bit lower. I want to have a 6% yield on it. Manulife has already hit that. IP, I'm not even. IIP, I'm looking at. I'm waiting for $12, and then I probably would go into it. But no offense, MHC is just better in every way. So we'll see. FN, I'm keeping an eye on it. I'm so heavy in REITs right now. I don't want to own it. Smart Center, I've kind of just have it here as a watch list, but I have no desire to buy it. Ollie, I would totally buy. I want to wait for the next financial report. PIC, I was eyeing it, but I'm not going to kind of stay away for now. BTP, I am still eyeing. I just haven't really had time to buy it. Tesla, why Tesla? I'm keeping an eye on both of these, but again, I'm mostly focusing on Tesla. I might buy why Tesla if we hit the $18 mark. I might even buy it now because it's an 18% yield, and I don't mind holding Tesla. And WP Carry, goal is to buy this before November because I really want to get in on a stock split. I know people hate it. I know people are upset because, they raised dividend and now they're immediately cutting it and spinning off their stuff. But if you calculate it, if they can spin off, their offices, pay, let's say even 10% of the amount, it's only a 10% div cut, and their payout ratio is safer, and they're losing a ton of debt because of the spin-off, the spin-off's just taking on the debt. Their spin-off is going to get destroyed. I'm very well aware of that, but it's also an extra source of income because, WP Carry can keep raising dividends. That one, if it stays flat, I'm more than happy to do it. But honestly, if it's if I can buy 10, 20 of this guy, I'd be happy. But, that spin-off, I might sell half at IPO and then I'll buy back later in and just see what happens. But yeah, honestly, it's a massive wait and see with WP Carry, but this is probably the next one I'm buying up. I know, oh my god, it's another REIT. REITs are good valuation, guys. Don't judge me. And that is pretty much it. Monthly distributions, $39.25. It's my birthday tomorrow, so spoiler, birthday money. Most of that's going into this. Then this is basically what we look like right now. I don't think anything's missing from here. Yeah, no, but this is basically every single month almost we're getting hiked except for March. Spoiler, Manulife does hike in March. June, I got no freaking idea. I think it's BMO. August, September could be Kroger. I'm just waiting for it to get cheaper. But yeah, like this, like legit, we could fill this up and go after the income stocks too if we really wanted to. And this is basically what we're looking at right now for progress. I'm waiting for October to finish up. And you know, we are gonna get a pretty sizable div cut purely because I just went heavy onto growth. I kind of again ditched Pimco, ditched Tesla, so we're gonna get kind of reamed for it. Tesla did pay though. Finally, it was very delayed. So we're just gonna have to wait and see what happens. But overall, guys, everything in here should be able to sustain the dividend, but only time will tell. And I'm pretty damn confident in everything. I'm iffy on Goff though. That's pretty much it for this update, guys. Have a good one. Bye.